You know when you trust your GPS completely? Like you
Yeah.
get into your car, you punch in an address, and you just expect the system to calculate the traffic, anticipate all the turns, and find the most efficient path.
Oh, yeah. You just turn your brain off and drive.
Exactly. But imagine if halfway through a massive cross-country trip, you realize that this navigation system doesn't actually know if you're driving a sports car or hauling a heavy trailer.
Right. It has no context.
Yeah, it doesn't know if you're alone or traveling with 5 kids. And worse, it might be routing you through the most expensive toll roads in the entire state just because, it's the standard route.
That is a very expensive realization to have halfway through a trip.
It really is. So, welcome to the Time and Market Deep Dive. Just a quick reminder before we put the car in gear today. This deep dive is strictly for entertainment purposes.
Yeah, we are just looking at the mechanics of investing here. You should always seek professional advice for your own personal financial decisions.
For sure. And hey, also drop a line in the comments and let us know what other topics you want us to explore in future deep dives. We love seeing those suggestions.
Absolutely. Keep them coming.
So today we are looking really closely at target date funds or TDFs. The mission today is to figure out if these wildly adopted, set it and forget it retirement vehicles are a financial dream or if they're actually a hidden toll trap.
And to answer that, we're synthesizing a massive stack of research today. We've got data from the Department of Labor, AARP, the Spark Institute, and PIMC.
It's a solid lineup.
It is. And alongside that, we're pulling independent analysis from Magnafina, Larson Financial, Elevation Financial, and her personal finance.
Okay, let's unpack this. If we're going to critique the route, I feel like we have to look at why literally everyone is driving on this specific highway.
Right, because target date funds absolutely dominate the retirement landscape right now.
They really do. And just for anyone listening who maybe isn't looking at their 401k statement every single day, a target date fund is an investment vehicle that automatically shifts your asset mix based on the year you plan to retire.
Yeah, the mechanics are pretty straightforward on the surface. If you want to retire in, say, 2060, you just buy a 2060 fund.
And it starts out heavily weighted in stocks, right? For that aggressive growth early on.
Exactly. And then it slowly, mechanically trades those stocks for bonds as you get older. That shifting mechanism is what the industry calls the glide path.
The glide path, which sounds very smooth and comforting.
It does. And that automated glide path is really the reason they have completely taken over. I mean, we're talking about roughly $3.3 trillion currently held in these funds.
Wait, trillion with a T?
Trillion with a T. Over 70% of new 401k contributions are going straight into them. But, that dominance wasn't exactly organic.
Right, because it stems from a very specific piece of legislation, doesn't it? The Pension Protection Act of 2006.
Yeah, the PPA. Because before 2006, companies were terrified. If they automatically enrolled you in a 401k and the market tanked, they were worried about being sued for putting your money in risky assets.
So default contributions usually just sat in a cash or money market fund, basically just losing out to inflation over time.
Exactly. It was terrible for long-term growth. So the Pension Protection Act changed the game by creating what are called qualified default investment alternatives.
QDIAs.
Yes. It essentially gave HR departments a legal safe harbor. They could automatically dump employee contributions into target date funds without fear of liability.
And human inertia basically just took over from there. I mean, most people simply do not opt out of the default setting on anything, let alone the retirement accounts.
Oh, absolutely. Which, to be fair, actually solves a massive behavioral problem.
Yeah, let's talk about the pros here, because these funds do force you to diversify. They automatically rebalance your portfolio.
Right. They act as these huge behavioral guardrails. So an emotional investor doesn't just panic and sell all their stock at the absolute bottom of a market crash.
Which is so common. People get scared, they log in, and they just hit sell.
That behavioral protection is arguably their absolute strongest feature. I mean, they're built perfectly for the hands-off investor who just doesn't have the time or the expertise to manage a custom portfolio.
They prevent catastrophic user error.
Exactly.
So bringing it back to the analogy, they really do operate like a fully autonomous car. You can literally take a nap on your way to retirement.
You really can.
But, and here's the pushback. If I am asleep at the wheel, I need to know exactly how much I'm paying the driver. And I need to know whether the software itself is fundamentally flawed.
Which brings us right to the toll booths, the double fee trap.
Yeah, this was highlighted in the Larson Financial data, and it is honestly kind of insidious.
It's a major structural issue that catches so many investors completely off guard, because many target date funds are actually constructed as funds of mutual funds.
Okay, break that down. What does that mean?
Well, instead of the fund manager buying individual stocks like Apple or, individual treasury bonds, they simply buy other mutual funds that their own company already manages.
So if I'm looking at my statement, I might see an overlay fee for the target date fund itself, and I'm just assuming that's the only cost I'm paying.
Exactly. You're paying that overlay fee to the manager just for the service of mechanically shifting the allocations on a calendar. But underneath that, you're also paying the individual expense ratios for every single mutual fund held inside that portfolio.
So you're literally paying twice.
You are. Larson Financial pulled the numbers on this. The average TDF expense ratio sits around 0.73%.
Which already sounds a bit high for a passive setup.
Right. But once those underlying fees are stacked on top of it, the total cost can easily push past 2.0%.
Wow.
Yeah, they cited the SunAmerica high watermark funds running at like 2.0%.
2.30%. To put that in perspective for you listening, a passive index target date fund from someone like Schwab runs at 0.08%, and Vanguard is around 0.20%.
Right. And a difference of 2 full percentage points might sound negligible if you're buying a cup of coffee, but in the context of compounding interest over 30 or 40 years,
It's catastrophic. It just devours a massive portion of your potential wealth.
it really does.
Yeah.
And this fee structure is a primary reason why these funds often practically guarantee underperformance.
And Elevation Financial actually quantified that underperformance, right?
They did. They found that TDFs often lag behind custom benchmarks by about 1% annually.
Okay, so half of that, like 0.55%, is purely from those layered fees we just talked about. But where is the other 0.45% coming from? Are the managers just making bad bets?
It's a combination of poor active management and the mechanical constraints of the fund itself. When managers try to tactically shift assets around to beat the market, they frequently fail. But more importantly, the fund's automatic rebalancing algorithm literally forces them to make counterintuitive trades.
Oh, this is what Magnafina highlighted, the mechanical flaw.
Exactly. To maintain that perfect, smooth glide path, the fund is forced to constantly sell the assets that are going up in value, just to buy more of the assets that are going down.
Sounds crazy when you say it out loud.
It does. But it's because the calendar dictates the asset mix. Say the algorithm says your portfolio must be 60% stocks and 40% bonds. And then we experience this huge multi-year bull market where your stocks just soar in value.
So suddenly stocks might make up 70% of your portfolio because they grew so much.
Right. But the fund doesn't look at market momentum. It doesn't look at economic conditions. It just blindly follows its programming. It sells off your best performing stocks to buy more bonds just to get back to that 60-40 split.
There was a brilliant quote from the legendary investor Peter Lynch in the sources that perfectly captures this. He said, "Selling your winners and holding your losers is like cutting the flowers and watering the weeds."
It's such a great analogy. You are systematically trimming your best assets.
And what's worse, if you hold one of these funds in a regular taxable brokerage account instead of a tax-sheltered 401k, the mechanical selling triggers a massive hidden toll booth.
Oh, the capital gains distribution trap. Yeah.
We saw this with Vanguard's 2025 fund. They expect to distribute 4.29% in capital gains to its investors this year. Explain the mechanics of that, because how does an investor get hit with a tax bill if they never actually clicked the sell button on their own account?
It's a great question. So when you own a mutual fund, you own a proportional slice of all the assets inside it. When the fund manager sells those winning stocks internally to rebalance the portfolio, they lock in a realized profit.
Okay.
And by law, mutual funds have to pass those capital gains down to the shareholders. So the fund generates a 4.29% gain, passes it to you, and suddenly you owe the IRS taxes on that distribution, entirely independent of your own trading activity.
Which means your autonomous car just drove you straight into a tax audit.
What's fascinating here is that TDFs are essentially designed for mediocrity. They aim to match the market minus fees, which compounds into a massive opportunity cost over 30 years.
Yeah, that's exactly it. And since we know these funds mechanically follow a set route, we have to look at the fact that different providers are actually driving to entirely different finish lines.
Yes, this is crucial.
Like even if you and I are the exact same age and we both buy a 2030 fund, we might end up with wildly different portfolios on the day we retire.
This is the to versus through glide path divergence. It is one of the most critical structural differences in retirement planning, and yet most investors have absolutely no idea it exists.
I certainly didn't until we dug into this. Let's break down those mechanics.
Okay, so a to glide path reaches its absolute most conservative allocation, meaning its lowest percentage of stocks and highest percentage of bonds exactly in your target retirement year. It glides to the landing pad and basically stops. A through glide path, on the other hand, maintains a much higher percentage of aggressive stocks at your retirement date. And then it continues to slowly reduce that equity exposure over the next 10 to 20 years. It glides through your retirement.
Okay, so a TOF fund is kind of like deploying a parachute the moment you cross the retirement finish line just to ensure you don't crash.
Right.
But a through fund is like deploying a hang glider because crossing the finish line is just the start of a 30-year retirement and you still need momentum to keep moving.
That perfectly illustrates the core trade-off here. It's a battle between two opposing forces, market risk and longevity risk. Plan Pilot data emphasizes that you really cannot minimize both simultaneously.
Right. Market risk being the danger of a stock market crash just wiping out your life savings right before you need to start spending it.
Yes.
And longevity risk is the danger of running out of money before you die simply because your portfolio didn't grow fast enough to beat inflation.
Exactly. So a two fund minimizes market risk. By aggressively shifting into bonds right at age 65, it shields your nest egg from a sudden crash. But because bonds generally offer lower returns, you increase your longevity risk. You might survive to age 95, but your money might run out at age 85.
Right. And the through fund tries to solve for that longevity risk. By keeping you heavily invested in stocks at age 65, it chases the growth you need to sustain you for 3 decades. But you are highly exposed to market risk.
Oh, massively exposed. If the economy tanks the year you retire, your portfolio takes a massive hit.
And her personal finance analyzed the providers on this, and the discrepancies are actually shocking. Fidelity, which uses a through approach, allocates 19% more of your money to stocks at retirement age than Schwab, which uses a conservative two approach.
A 19% difference in equity allocation for two individuals retiring in the exact same year is just staggering. It completely changes the risk profile of the portfolio.
I mean, if Fidelity is putting 19% more in stocks than Schwab, one of them has to be fundamentally wrong about risk, right? How does the Department of Labor justify allowing both of these funds to carry the exact same 2030 label when they are operating with totally different investment philosophies?
Well, the Department of Labor actually issues warnings about this exact issue. They note that identical target dates can have drastically different investment strategies. And they issue that warning specifically because of something called sequence of returns risk.
Let's drill into the math of that, because PIMCO's historical data going all the way back from 1880 to 2020 really highlights why the sequence of your returns matters so much more than the average of your returns.
Yes, think about what happens if you take a withdrawal during a severe market drop. Let's say you have $1 million, and the market drops 20% in your very first year of retirement.
Ouch. Okay.
So your portfolio is down to $800,000. But you also need to withdraw $50,000 just to pay your living expenses. Now your balance is $750,000.
You just locked in the loss. You didn't just lose market value on paper. You permanently removed the shares that could have eventually recovered when the market bounced back.
Exactly. You sold them at the bottom. And to get back to $1 million from $750,000, you don't just need a 20% gain.
Right, because the base is smaller now.
Mathematically, you need a massive 33% gain just to break even. This is sequence of returns risk. Experiencing negative returns early in retirement mathematically cripples your portfolio's ability to recover.
So PIMCO found that in highly volatile adverse markets, the conservative two path actually preserves your capital much better in those fragile first few years. It acts as a shield against that sequence risk.
It does. However, and this is the kicker, PIMCO's 140-year analysis also revealed that over the very long run, both the to and through approaches support similar feasible spending levels.
Wait, really? After all that?
Yeah, usually around 4% to 5% of your initial balance annually. The final destination might look similar on a spreadsheet, but the emotional bumpiness of the actual ride is totally different.
Which is deeply concerning, because even if you manage to choose the glide path that perfectly matches your emotional tolerance for bumpiness, the fund itself is still driving blind. It has zero awareness of your actual life.
And this is the ultimate one-size-fits-all flaw that Magnafina and Elevation Financial point out. A target date fund operates on a single data point, your birth year.
That's it. It doesn't know if you have a chronic health condition. It doesn't know your spouse's retirement timeline.
No.
It doesn't know if you have a massive pension or if you're aggressively pursuing FIRE, financial independence, retire early. If I want to retire at 50, but my 2040 fund assumes I'm working until 65, it's going to keep me in aggressive stocks way too long. It's entirely disconnected from my actual withdrawal timeline.
It operates completely in a vacuum. And relying on a rigid algorithm becomes incredibly dangerous when the macroeconomic weather turns hostile.
The 2022 bloodbath is the perfect case study for this. I mean, if you're listening to this right now, you're probably thinking about what happened to your own 401k a few years ago.
AARP published the post-mortem data on 2022, and it shows exactly what happens when the traditional rules of investing fundamentally break down. In 2022, target date funds aiming for the year 2030 lost an average of 20.4%.
Over 20%. For people who are only 8 years away from retirement, that is the exact phase where the glide path is supposed to be protecting them.
Exactly. The safety net failed because the fundamental mechanism of bonds inverted. Usually stocks and bonds move in opposite directions, right? Bonds are the shock absorbers.
Right.
But you have to understand bond pricing to see why 2022 is different. Think of a bond like a fixed contract paying 2% interest.
Okay, so I hold a piece of paper that pays me 2% a year.
Right. If inflation suddenly spikes, the Federal Reserve raises interest rates to cool the economy down. Now the government is issuing brand new bonds that pay 5%. Suddenly, nobody in the open market wants to buy your old 2% bond.
Because why would they when they can get 5%?
Exactly. The only way you can sell your old bond is by slashing the price of the bond itself.
So when interest rates go up rapidly, the value of existing bonds just plummets.
Yes. In 2022, inflation caused massive stock market sell-offs, and the subsequent interest rate hikes caused the bond market to collapse simultaneously. Investors lost double digits on their aggressive stocks, and they lost double digits on their supposedly safe bonds.
Wow.
The algorithm blindly shifted money into an asset class that was actively crashing.
This reveals a massive blind spot. Traditional TDFs just bounce back and forth between stocks and nominal bonds. They have absolutely zero built-in defense against inflation. So how are institutions trying to fix this?
Well, the Spark Institute and PMCO argue that to survive an inflationary environment, portfolios must include active fixed income management and exposure to real assets. We are talking about incorporating assets that naturally rise with inflation.
Like commodities or real estate investment trusts, REITs and TIPS Treasury inflation-protected securities.
Precisely. State Street, for example, manages their target retirement strategies by maintaining a 26.5% strategic allocation to those specific inflation-sensitive assets.
And PIMCO proved that this actually works historically, right?
They ran the models. PIMCO demonstrated that reallocating just 20% of a portfolio into inflation-mitigating assets, combined with active fixed income management, dramatically improves retirement outcomes.
That's significant.
It acts as an anchor. It allows retirees to sustain their spending power even during the most adverse inflationary periods in history without actually increasing the overall risk profile of the fund.
Okay, but if I'm an investor listening to this and I realize my 2030 fund is heavily weighted in nominal bonds right as inflation is running hot, my immediate instinct is to just pull my money out, fire their autonomous driver, and build my own portfolio of real assets.
Right.
But AARP actually says to stay the course. Why would they say that?
Because reactionary panic selling is almost always destructive. AARP points out that historically the average bear market lasts about 11 months. If you pull your money out at the absolute bottom, you miss the inevitable recovery rally and you lock in permanent losses.
So staying the course means not abandoning the market entirely.
Yes, but it does not mean staying blind.
You have to actually look at the route.
Investors absolutely must monitor their TDF. You need to look under the hood to ensure the fund's underlying strategy actually aligns with your real-world risk tolerance, your tax situation, and the current macroeconomic reality.
So what does this all mean? Let's bring this all together. Target date funds are an undeniable triumph of behavioral economics. They get people invested, they automate diversification, and they prevent us from making emotional, catastrophic trading errors.
Yeah.
But you pay a steep toll for that convenience. You pay in layered fees, you pay in hidden tax distributions, and you sacrifice all personalization.
If we connect this to the bigger picture, our call to action for you listening today is to actively investigate your own automated strategy. Log into your 401k or your IRA. Find out the exact ticker symbol of your target date fund. Look at the expense ratio. Are you paying 0.08% or 2.0%?
Such a huge difference.
Dig into the prospectus to determine if it is a to fund or a through fund. Really understand your exposure to market risk versus longevity risk.
Look at the actual roadmap. Does this algorithm know enough about your financial life to safely guide you to your retirement? Which leads to a final provocative thought to leave you with today. Target date funds were built on an industrial era premise, the idea that an entire generation, simply because they were born in the same year, shares the exact same risk profile, health trajectory, and financial
Like
goals.
we know isn't true.
Right. But we are moving rapidly into a new era of technology. What happens when artificial intelligence allows every single retirement account to be hyper-personalized at scale?
Oh, wow.
If an AI system can actively manage a custom glide path based on your real-time health data, your daily spending habits, your specific tax brackets, and macroeconomic inflation indicators, all for a fraction of the cost of a traditional fund manager, will the mass-market target date fund soon become a relic of the past? Will the concept of a one-size-fits-all GPS finally become obsolete?
That is a fascinating question.
Something to mull over. Until next time, keep diving deep.